Thanks for joining us for an introductory discussion of Elliott wave theory. Before we begin our discussion of trading with Elliott wave, let's set the stage by looking at both a common buy setup and a common sell setup to try and help understand how Elliott wave theory was discovered and why it's so popular today. Here's an example of a classic buying opportunity. The market is in a strong uptrend and has pulled back down to a support level. At this time, traders can use a technical indicator or a candle formation to help time their entry into a trade. They're looking for a reversal back to the upside in the direction of the prevailing trend. But even then, there's really no way for them to know for sure if the uptrend is still intact and if the market will rally in the direction they expect. If it does, they'll most likely find themselves in a promising trade. If it doesn't, they'll likely find themselves in a losing trade. Here's an example of a classic selling opportunity. You can see that the market is in a strong downtrend, and because of this, traders will often look for additional opportunities to open trades in the direction of the trend. So as the market rallies up to a resistance level like it has here, traders again can use a technical indicator or a candle formation to help time their entry, placing a trade short in the direction of the prevailing trend. Now they're looking for a reversal back to the downside. But again, there's no way to know for sure if there will be more selling to keep the downtrend intact. If there is, they will probably be happy with the trade. If there is not, they will probably end up in a losing trade and can only wish that they had known how the market was going to react prior to entering. While most experienced traders realize that more often than not, the trend will remain intact in these situations, there have been and probably always will be attempts to judge the chance of a current trend continuing or changing at these key points. One of the most popular methods today is the use of Elliott wave theory. In the 1930s, Ralph Nelson Ellitt set out to try to learn more about the stock market after experiencing some losses in the 1929 crash. After careful study, he began to notice that the market traded in a series of waves. Elliott observed that a trending move in the direction of the prevailing trend could be broken down into a 5-wave series. He labeled these waves 1 through 5. He began to notice that the first, third, and fifth waves often formed in the direction of the trend, and the second and fourth waves often formed against the prevailing trend. Next, Elliott noticed that after a 5-wave move in the direction of the prevailing trend, there was a 3-wave move in the counter-trend direction. He labeled these waves A, B, and C. From this simple discovery, Elliott appeared to be onto something quite useful. To better understand Elliott's next discovery, let's put ourselves in his shoes, and let's take a look at this basic 5-3 wave pattern to see if there's something that can be inferred from it. Thus far, Elliott has discovered two things. One, that there is often a series of 5 waves in the direction of the prevailing trend. And two, that 5-wave series is often followed by a series of 3 waves in the counter-trend direction. But wait, these are waves. Waves ebb and flow. Or better stated in trading terms, waves oscillate up and down. Knowing that each impulse and correction is a series of waves oscillating up and down, what might we conclude? How about this? And now we come to Elliott's next discovery. In his studies, Elliott noticed that you can have waves within waves, which means that a 5-wave sequence in one time frame may be the 3rd wave in a longer time frame. It appeared that this observation might be leading him towards something really big. Had Elliott found a way to better determine if the trend would continue or change? Had he found a way to overcome the challenge we outlined at the beginning of this video? To find out, let's go back and look at the classic buy setup we saw at the beginning of this lesson to see if Elliott's discovery can assist us in determining when to enter into a trade. We identified the potential buy as a pullback from a high down to support when the market is in an uptrend. Ideally, we would enter on a test of support or on a bounce up off of that support level. But as we stated previously, we still don't know with confidence if the market will continue up after we buy, even though we are trading in the direction of the trend. However, if we know that the pullback was wave 2 or wave 4 in a 5-wave sequence, we now have another good reason to enter into the trade with the expectation of more upside. And that's exactly what we have here. As price action develops, we can see that waves 1, 2, and 3 begin to form quite clearly. Therefore, when this pullback here occurs, we can more confidently enter into our buy position, as we expect this to be the pullback in wave 4, with the next move in the direction of the trend to form wave 5, which it does. Let's also take a look at the sell setup from the beginning of the lesson. We identified the potential sell as a rally up to resistance when the market is in a downtrend. We would enter on a test of resistance or on a bounce down off of that resistance level. But again, we don't know for sure if the downtrend will continue after we sell, even though we're trading in the direction of the trend. But once again, if we can identify the rally up to resistance as wave 2 or wave 4 and the trend move down, we now have increased confidence in the possibility of more selling pressure and another move down. Although wave 1 is often difficult to recognize until after the fact, with this trade we can actually see quite clearly that wave 1 and wave 2 have formed. The expectation is for the next move to be wave 3, which should be in the direction of the prevailing trend, and that's exactly how things play out here. So with the use of Elliott wave, we've added a level of confidence to the entries we've taken on these trades, further increasing our chance of success. Of course, there's no way to guarantee that our trades will turn out to be profitable, but using techniques like Elliott wave theory can help increase our chance of success and help mitigate our risk of loss. Now, many traders like to use multiple time frames in their approach to trading, and Elliott wave can be quite valuable in this regard. Here's an example of a potential sell setup on a 4-hour chart. Note that we can see where this pullback up to resistance could be considered the completion of wave C. From this point, we can expect the trend to continue. However, we don't know if this will happen for sure or not. What can we do to further increase our confidence in the outcome? If we zoom out and look at a daily chart, we can see that the completion of wave C on the 4-hour chart is also the completion of wave 2 on the daily chart. After wave 2, we expect the move to be wave 3 in the direction of the trend. So we can with greater confidence expect that the next move will likely be wave 1 on our 4-hour chart or wave 3 on our daily chart. Either way, we expect the move to be in the direction of the prevailing trend. And looking over the long term on this daily chart, we can see that that's exactly how things played out. Because the 5-3 wave pattern is evident at all degrees of trend, locating wave patterns at smaller time frames that support wave patterns on larger time frames can be further justification to enter certain trades. Now, from a trading perspective, it's not important to fit every market movement into a wave pattern. In fact, sometimes there will not be a clear pattern at all. This is not a problem, however. In fact, this is one of the great benefits of trading with Elliott wave. You can better gauge when to take action. Overtrading is one of the biggest barriers to success for many traders, and Elliott wave helps to solve this problem because you only enter the market when the patterns are clear. In closing, it's worth noting that a large part of mastering Elliott wave theory is having an in-depth understanding of wave patterns. The examples that we worked with in this video only illustrated the most basic wave forms. However, there are many more waveforms, some quite complex, as well as a number of rules that can be applied to each type of waveform and to each individual wave itself. Just like learning a new language, Elliott wave traders should be careful to study the language of Elliott wave to make sure that they use the techniques properly. Because of this fact, and because Elliott wave is so popular in general, DailyFX hosts a great forum that we highly recommend you utilize. In fact, this is one of our most heavily visited forums and will provide you with a wealth of knowledge on understanding and using Elliott wave theory in your trading. Additionally, wave counts for a number of currency pairs can be found every day in the technical analysis section of DailyFX. This is a great way for new Elliotticians to begin recognizing wave patterns by the help of a DailyFX analyst. And finally, for those who truly want to dive deep into the subject, we recommend 2 books that cover Elliott wave in great detail. Elliott Wave Principle by A.J. Frost and Robert Prechter, and Sentiment in the Forex Market by Jamie Setley, Senior Currency Strategist at DailyFX. Both of these books can be purchased at Amazon.com, among other places. This concludes our introduction of Elliott wave theory. Thanks for watching and good luck with your trading.